So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I am joined today by Eugene Trowbridge. As founding partner of Trowbridge Law Group, Eugene's law practice concentrates on the syndication of commercial and investment real estate through both debt and equity. Eugene has represented over 500 clients in this area of practice. The median offering size is $3 million, but he has done individual offerings of over $5 billion. His practice writes offerings under Rule 506B and 506C of Regulation D. As former syndicator who for 10 years raised investor capital through the broker-dealer community, he's able to communicate with his clients on both the technical and the practical aspects of state and federal securities law. As longtime CCIM and CCIM senior instructor, Gene has won numerous awards for his teaching ability. His book, It's a Whole New Business, is a really how-to manual on real estate syndication. Gene, welcome to the show.
Well, thank you, Jonathan. It's a pleasure to be with you today.
Yeah, that's quite the resume, so I'm really excited to get into it. But let's kind of start at the beginning. Just give us kind of the short version of how you kind of got into all of this.
Well, I got into it. I came out of college and I went off to be a commercial real estate broker. Did that 7-8 years. Then I decided I wanted to buy some property. Then, like every other syndicator, Jonathan, I ran out of money to buy my own properties. So I started pooling money with friends and family, if you would. And that led to a 20-year career in being a syndicator, where we primarily built self-storage facilities in Southern California. We would buy the dirt, we would build the facility, we would get it 50% occupied, and then we would sell it to a long-term operator. We were not in the business of operating storage facilities. We were in the business of selling and making a profit. And then at some point, I know that not everyone understands this, but the care and maintenance of partners can sometimes get to you, can be overwhelming. And we had quite a few partners. One year I sent out 1,867 K1s.
Holy cow.
And that was a lot. So I went home one day and said to my wife, as we were sitting around the kitchen table, Jonathan, where all the good decisions in life are made, I said, I quit. I'm going to go to law school.
Oh, wow.
So at 45, I went to law school to become a lawyer in the syndication world. I was only going to do one thing. I was going to help people do exactly what I had been doing as a syndicator. And I was going to do that for 15 years, from 45 to 60. Okay. So I'll be 74 this month. And I'm still doing it. It's a good business and I love it. And that's how I got here.
Awesome. I love it. What a great story. Went back at 45 and decided, did you always kind of have that in the back of your mind that you wanted to get into the side of things?
Not really, but I did want to mentor and I did want to stay in the industry. And so I really needed a product. And I thought the product could be my legal practice. So I figured, well, if I can get to be an attorney, which was questionable, if I get to be an attorney and then I can write the documents and I can do quite a bit of mentoring. And that has worked pretty well.
Awesome. I love that. That's great. Well, let's kind of jump into it now, kind of talk about, what even is a syndication. Let's kind of, go high level and then we'll get into the weeds of it all.
Okay, well, a syndication is just simply two or more people pooling their money, their management skills to do something for a business. I mean, when you go to the movie or you watch a movie on television, at the beginning, it has all these companies that show up on the screen. Well, they're all pooling money. And so that's a syndication. So I get a lot of questions. People call me and say, hey, I want to put 10 people together, but I don't want it to be a syndication. Bad question. What they're really saying is I don't want it to be a security because I think I've heard something that makes it very confusing. Well, too bad. It is a syndication, and more than likely it is a security. And so when it's a security, no matter what your background is, when I was a real estate guy and I realized I went into the securities world, I looked at that as a whole new business. It's just totally new, totally different laws. You have to do everything exactly the right way. Let me show you a picture if I can. I'm going to have to scroll through one or two here to get where I am. On this flow chart, the question is your syndication a security? Now, we could have this answer over here. No, it's not a security because it's member managed. You and I, Jonathan, could go out and form an LLC, and we could put up some money and we could run it ourselves, make all the votes unanimous. So no one controls anyone else's ownership. That's member managed. That's not a security. What the government is concerned about is when someone's in charge of someone else's money. If you and I went together and did something and I said, hey, Jonathan, the property's in California, you don't have to come out, just send me your money, I'll take care of it all. Now we got a manager managed entity, which makes it a security. And then in the securities world, there's a couple of ways you can go. The rule is, Jonathan, that every security has to be registered with the SEC. We don't want to do that. Too much work. So we want to get down here to offerings that are exempt from the SEC registration, right? Let me tell you about that red box right there. The report just came out from the SEC last month. For the last 12 months, they do an experience report. And there was over $2 trillion raised in offerings that are exempt from SEC regulation called private placement. That's more than the new money that was raised on Wall Street in the same time. This is huge business. You can imagine it's not all real estate.
Right.
So it is offerings exempt from registration, and where 99% of that 2 trillion is raised is right here in Regulation D. And as we were talking before, we wanted to talk a little bit to the people about the difference in 506B and 506C. Is that right? We want to do that?
Yeah, absolutely. Let's get into it.
Okay. Well, 1981, I hate to be a historian, but 1981 Regulation D was started, and it started with a way that you could do offerings and not have to go to the SEC. And it was what's in this box today. I could raise as much money as I wanted. And this is when I was syndicating. I could have as many accredited investors, people who have $1 million or make $200,000 or $300,000 a year. All I have to do is have the investors check a box because I know them, because there's no advertising or solicitation. So some people call this the friends and family offering. That isn't really what it is, but if you have a pre-existing relationship with someone, you can put them in here. As many accredited investors and 35 sophisticated investors. That was a big change in 1981, that you could actually take people who weren't accredited. And the purpose for that was to promote capital formation. So people that are raising money like this, right, Jonathan?
Absolutely.
And you've heard this. Most of the people are doing this. About 97% of that 2 trillion is raised in 506B today.
Interesting.
But then the Jobs Act came along 2012, 2013 and said, we need to promote capital formation. So over here, you can't advertise. So when I was doing it, the only people who could invest with me were people that I knew. And those are the only people I could ask. And then all the accredited investors who were out there, if they didn't know me, they couldn't invest in my deal. But with the ability to advertise and solicit, if this had been around when I was syndicating, I could have gone out and tried to find the accredited investors and put myself on social media so they could find me, right? So here comes 506C, same basic issue. We can raise as much money as we want. We can have an unlimited number of accredited investors. But because we don't know everyone, they can't just check the box. We have to do some third-party verification. No sophisticated investors, got to write a PPM document, and we can advertise. So that's where I'm doing business. And Jonathan, that's where all the people who listen to you and talk to you are doing syndication, are doing their business. 97% is here, 3% is there, but this is growing. You know, and it's been around for what, 10 years. It's all the way up to 3%. Okay. The reason why this is so strong is most syndicators know all their investors. They've been doing it for a long time. They don't need new investors. And so they just go and let the investors check the box.
And on the 506B side, even if they are accredited, you still have to know them, right? So that's kind of the biggest caveat there, is that you have to have
no advertising. So in order to protect yourself, if you were charged with advertising, you'd have to say, no, I had a pre-existing relationship. I have some documentation that you knew the person before you brought your offering out, and it was a substantive relationship. Too many people think, well, I'll just get Jonathan's email, put it in my database, and now I know him. And so if I bring out an offering next week, I can ask him to invest, but I really don't know Jonathan that well to know what his background is, his experience, whether he's accredited, and he doesn't know me at all. I just have his email address. So that's pre-existing and substantive are the two words. Even if they're accredited, it doesn't make any difference.
So what does it look like in terms of establishing a pre-existing relationship? I know there's even a cool-off period potentially. So kind of talk about what exactly that looks like.
Well,
or how they define it, I guess.
Yeah, they have written some definitions, and it's no bright line. There's no one thing that you can absolutely be certain, but pre-existing is going to be prior to you as a sponsor, Jonathan, signing a fee agreement with me to do your offering. The minute you sign that fee agreement, you have a contemplated offering, and your database kind of freezes at that point. You can put new people in your database, but they can't invest in this deal, okay, because it's not pre-existing. But then substantive goes on to say, does the sponsor know enough about the person's business experience, their finances? Do they know if they're accredited? Do they know if they're just sophisticated? Does the person know enough about the sponsor? What is his track record? What does he do? So it takes the development of a relationship. You know, in my YouTube channel, I've got a good YouTube on, it's called 3 words, sophisticated, pre-existing, and substantive, if your viewers want more of a definition than that. Whereas if you advertise, you don't need to know them all. If you can, you put something on the social media and just have the people send you a check.
And for that, obviously, so let's kind of switch over to the 506C now. That obviously, they have to be accredited. That requires third party, typically going to be like their CPA. Lawyers can do it as well.
Mm-hmm.
So kind of define what accredited means, or well,
okay,
what it means.
The broadest part of an accredited investor definition is that the person has $1 million of net worth, and it cannot include equity in their principal residence. And or they make $200,000 a year if they file an individual tax return, or $300,000 if they're married filing jointly, or they're in a household where 2 adults are running the household. And while they're not married, the term is spousal equivalent. 2 people living together can combine their net worth and their income to reach the 300 level or the $1 million level. And that's brand new 2 years ago. Then there are other offshoots of accredited investor. One, probably the most important one that might be good is that if you have an entity that wants to invest with you, let's say you're doing a deal and I wanted to put my company's 401k in your deal, and my company has 8 or 9 people in it. What are we? Well, if the 401k has $5 million in assets, the 401k is accredited. Forget about who the people are. So family offices, trusts, things like that. If there's $5 million in assets, the entity is accredited, and we don't have to go any further. Those are probably the major definitions you need to know, Jonathan.
Okay, awesome. Yeah, that makes perfect sense. So really you can have, 2 people, married, and they make, 150, and then they can combine for that 300.
Absolutely. If they file jointly now, if they're filing separately, we've got a problem.
Okay. That's the caveat. They have to file jointly.
Married filing jointly, or the spousal equivalent. And that's kind of an interesting question. If they're married, but filing as individuals, which is a possibility, I don't think they'd qualify as the spousal equivalent because they really are married, but they're filing separately. I don't know if that's the answer. I've never researched that because it hasn't come up.
Got it. And then if I understand correctly, if you're setting up, let's say like a fund, right, like a SPV or something, if you're not personally accredited, but you're the manager or an officer of the fund, then you can invest into the 506c
Sure.
fund. Is that correct?
If the sponsor, the officers, the key principles are defined as accredited, period.
Awesome. Okay. So that allows, non-accredited people when they set
Be
up.
sponsors, right?
Okay. Awesome. And so so you kind of touched on it before, but it sounds like the biggest thing for the 506b is just because, like you said, most syndicators know all of their investors. But what's starting to happen, and what, is with the digital age, is people are just building these huge lists of investors by, ebooks and all these different kind of lead tools, and then, just building a list. And from there, that's when you have to stick to the 506c.
Yes, I believe that is the truth. For example, our last firm actually did Grant Cardone's first Reg A Plus offering, and he needed that because he was going to go to Vegas at the Monte Carlo Hotel and stand in front of an audience of 10, 12,000 people and pitch his deal. Of course, he didn't know them, and most of them weren't accredited. So Regulation A will let you advertise like that and take people who are non-accredited. I mean, you can only raise 75 million. 506c says you could raise as much as you want. We did an offering last year for 175 million 506c. And we did it to a group who had a bunch of family offices that they had in their database, but they really didn't have a substantive relationship with them. And so to avoid any problems, we just said, okay, this is advertising. And they're all going to be accredited anyhow, because they all have that $5 million worth of assets. We had someone else come to us, kind of interesting, who thought a Reg A offering would work. They have 88,000 people subscribing to their YouTube channel.
Holy cow.
About buying real estate, and they don't know any of them. And they certainly don't know if they're accredited or not. Many of them aren't. So they thought about a Reg A, but they walked away from that because of the time and the expense, and they could only raise 75 million. So they went to a 506c and advertised all 88,000 people, but they could only take accredited investors.
And if I understand correctly, Regulation A makes it a public offering. Is that correct?
Kind of. It's quasi-public. It's still not full registration with the SEC, but you can advertise. But the SEC gets totally involved in what your paperwork is, what representations you're making. Can you prove your your track record and all that. It's 6-8 months and maybe $200,000 to get that approved, where these two we'd probably do in 3 weeks. So it's a big deal. I will tell you that my most prolific client, since I really started keeping track in 2014, has done 154 of these offerings.
Wow.
506B. Everyone's accredited investors only, with a pre-existing relationship with everyone because they've all invested basically with him before, right? And they just check the box. They don't have to go anywhere to get verification. And if he went over here, a lot of these people wouldn't want to give up their tax returns and their other information. So that is kind of a barrier to him, but it doesn't seem to stop him.
Interesting. Okay. So let's kind of touch what kind of misconceptions are there around these offerings, if any? Okay.
I'll tell you, one of the misconceptions is, and you kind of talked about it, you use the term cooling off period. There was a no action letter. And how do you get a no action letter? You send to the SEC, this is what I'm going to do. And if I do this, just this, tell me now that you will take no action against me. Okay, so there was a company that had a no action letter where they wanted to go on the web. They wanted to talk generically about their offering, about their company. They wanted to get people to sign up for a pre-qualification questionnaire, and they wanted to interview the people, find out about them to see if they were qualified. And then if they were, they said, okay, you're in the list, but you can't buy anything for 30 days. Okay.
Got it.
That worked for them, but there were a lot of steps up to the 30 days, not just like taking their name and putting it on the database. And then 30 days later, out of the blue, you call and ask them for to invest. That is work. Another misconception is the 3-touch rule. There was another company who asked for advice and a no action letter and said, these are the 3 ways I'm going to reach an investor before I make an offer, and very specific. And the no action letter came out and said, yes, if you do that, that's fine. Well, no action letters are only binding on the person who asked for it. It's not a global 3-touch. So there's no such thing as a 30-day cooling off period unless you get permission from the SEC. There's no such thing as a 3-touch rule unless you ask for your own no action letter. You just have to understand what pre-existing means and what substitute means.
Okay, yeah, that makes perfect sense. And so it sounds like then the first company was able to advertise to a certain degree, but giving up that, hey, we're going to wait 30 days before we.
Right. But you have to understand that first, it was a company that was called IPO Net, if anyone wants to look that up, IPO Net. And the company was going to, tell people about investing in IPO offerings.
Okay.
And so what their advertisement was totally generic. What is the IPO industry? What type of companies do IPOs? If you're interested, push a button and up comes the pre-qualification questionnaire, fill it out, push a button, submit it to us. We'll have one of our counselors call you and do an interview. And if you deem to be a person who can take the risk of doing an IPO offering, we'll let you know in 30 days when we have one that might be good for you.
Okay, interesting. So really, it's just about staying, in touch with the SEC and letting them know, what you're going to be doing if you're going to do things differently than what's defined right
if
there.
If you're going to do a no action letter, that's going to take you 6-8 months to get that response. The idea is just to get with a lawyer who knows what they're doing and just follow the lawyer's advice, I would say.
Okay, good to know.
One of the things here's another misconception, and you see this on the internet, Jonathan. Here's Gene Trowbridge standing in front of a monument sign for the Windsock apartments with 20 or 30 people. Oh, I've gathered all my investors together and we're so excited about, we just bought the Windsock apartment. And I think we're going to do 3X in equity and we got a 14% cash on cash. And isn't that great? About a deal that they just finished. The SEC says that's advertising. You've just blown your exemption right now if you don't come out with a 506C next, because the SEC's perception is all of those 20 people knew you just did this deal. They know what the yield is. Why would you be putting that out? We'd be putting that out to get new people to come to you. So it's obviously advertising. So you have to be very careful about that.
Oh, so you can't even advertise a deal that's already closed.
And their feeling is the only reason you'd be doing that is to get new people calling you and say, hey, Jonathan, the next time you have a deal, count on me. Well, that's fine if you're doing 506, fine. But if you're doing 506B, you just screwed your exemption on your next deal.
Interesting. Okay. And so it carries over. So the next one would have to be a 506C or else they're going to come at you.
Yeah, it's a little technical, but yes, that's exactly right.
Okay. Got it. So moving forward, what kind of legislation are you keeping an eye on, if any, that could potentially make changes to this?
Well, the legislation that just came out that affects this would be, can you do a 506B and a 506C in the same offering? And the answer is yes.
Really?
How you do it is you draft one set of paperwork, and the paperwork says, we're going to start right here. We're going to raise as much money as we can from our friends and family, the people that we know. And if we don't raise all the money maybe by a certain date, we're going to stop that. There's going to be a definitive and unambiguous break right here. And how we do that is we file a Form D with the SEC and says this part of the offering's over. Now we come out with this part of the offering and we start advertising to people, and we take people in the 506. Same offering, but the method of offering can be in two parts. You should have an attorney help you with that if you're going to do that. But that's probably the hottest thing that's hit the wire since the first of the year, and that's pretty darn good. I think that what I'm interested in is how will the SEC either tighten or loosen up capital formation? Do they want more than $2 trillion coming into the market? Because, like I said, it's just a very small number, maybe 100 billion in real estate. But all the other businesses that once they get their bank loans and their own money, they need to go to the public and raise money, but they don't want to go on Wall Street. So if Congress or the SEC thinks they need to promote capital formation, they'll come out with something that's does that. And I don't know what it is, but that's what I'm watching. And then the other side of the coin, you're always watching, and we're not even talking about this, 1031 exchanges. There's always, as long as I've had gray hair, every single year, there's the word that Congress may very well limit the ability of doing 1031 exchanges. And that does affect this business, because if you have equity, you cannot put equity from a property that you own into an LLC.
Right.
Because the LLC is personal property. You need to go into real estate. So it means that my 506B offering may be a tenant in common offering. One part is an LLC where we raised a bunch of money, and the other part is Jonathan with his $2 million of gain from the previous property. Okay, if that goes away, that's going to be an issue. We're doing one of those every month. We're doing a tenant in common transaction every month, because anyone who's bought, let's just say, multifamily in the last 6 or 7 years has a bunch of gain, has a bunch of equity, and they don't want to pay taxes.
Okay, that makes perfect sense. And so from what I understand, the 1031's kind of, like you said, always been on the chopping block potentially. Initially, it was only for like business assets, and then they added the real estate. And so now they're potentially going to take the real estate back again.
Actually, what they did recently is they took the personal property out of it. For the long time, most 1031s were corporate assets. Like, I have a plant with a bunch of equipment and it's too small for me. I'll sell it and take the money and buy a bigger plant with a bunch of equipment and gain. Well, the last change was all the personal property that's in that plant can no longer be exchanged tax-free. It becomes a transaction where the real estate moves on, but the personal property is sold and you have to pay taxes on it.
Interesting. And what's kind of the logic behind this? Are they missing out on just a lot of revenue? Is that kind of how they
Sure.
see it, or?
Sure, they think that's the case, and I'm sure they think that only rich people do 1031 exchanges, but that's not the case. You probably know a bunch of people that have had houses that they had for 2 or 3 years, and they've built up some equity, and now they want to exchange into a fourplex. You know, certainly. But that's all taxes. That's for another event, Jonathan. Okay.
Absolutely. Yeah, we are actually coming up on the time. So that's a perfect segue. So I do have 5 questions that I ask all of my guests. They're the final 5. First one is, what's the best advice you've gotten from a mentor?
Oh, the best advice I always hear from a mentor is don't try this yourself. If you're going to be a syndicator, and on my YouTube channel, I've got 37 interviews with good clients of mine, and that's my last question. What advice would you give a rookie? And everyone in one frame or another has said, form a team, get some brand recognition, and don't try to do this yourself. Even in my law practice, I mean, I was an individual solo practitioner for a while, but my business never grew until I started taking on partners and other people.
Awesome. I love that. That's such a great point. What is it about your career that makes you feel like you're fulfilling your why?
I think that today, you know, it's funny, when I was managing a lot of people's money in my syndications, I knew that that was cool, but that's not as cool as helping people get started in the syndication business. I'm totally have a significance in their life by helping them do this successfully and giving them, you know, I know all the mistakes. I probably don't know all of them, but I know all that I made, and I can see all sorts of mistakes that other people make. And so I can help my clients to stay away from that. I think that makes a significance in me. That's why I'm still doing it. You know, I'm 13 years past my retirement age.
I love that. That's awesome. Yeah. And like you said, you know, it kind of runs smoothly now. You brought on partners, so I'm sure it's not quite as a heavy load as it was in the beginning. What is your favorite non-real estate or investment related book?
The Shack.
Okay.
The Shack is a book about loss, and that's relevant to me, the loss of a child, and that's my favorite book.
Awesome. Love that. If you could have any superpower, what would it be?
Being sure I actually knew what my wife meant. We will have been married 50 years this coming month.
Oh, congratulations,
Jonathan. And I'm still not exactly sure what the communication pattern is, but it's worked pretty well.
Oh, I love that. That's amazing. Well, congrats on that. And last one, we didn't really talk about your book, and you know, I know you have the YouTube channel. So what's the best way for people to get a hold of you and learn more?
Okay, let me see if I can get here in a second. So this particular slide, if they're watching this, they can click on that QR code, and I will send them a free PDF of my book. And I think that's great. Or they can go to my website, which is TrowbridgeLawGroup.com, and they can get a book there. And send me an email, Gene@TrowbridgeLawGroup.com, and I'll send you a PDF of the book.
Perfect. Yeah, we will link that in the show notes. Gene, thank you so much. This has been amazing.
Okay, Jonathan, it's my pleasure. Let's do it again.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.